Okay, banks, they're going to be in focus considering the RBI has set the debt recast rules. They've accepted the recommendations made by the KV Kamath-led panel. In fact, I'm going to take it across to consulting editor at Mythili Bhusnurmath to get in her perspective on what these recommendations would really mean for banking as a sector.
The committee has done its job, which is asked to do, which was to define the various ratios for different sectors. So it has done them for 26. So that part of the job the committee has done. But will this really materially help in providing succor to the borrowers and to the sectors that really need help? The answer to that is no. Because frankly, I think the entire process of what we've gone through, both in the RBI's resolution guidelines and as a result of the Kamath committee submitting those ratios, is that we made the entire lending exercise a somewhat mechanistic ticking of the boxes, rather than what it should be, a commercial decision, a financial decision, which always involves an element of risk. You raise the question of whether 2 years down the line, whether companies would be in fighting fit. Well, that's an answer to which perhaps even God doesn't have an answer today, because nobody really knows. The level of uncertainty is so much. So I think what was missing in the entire process is the RBI has not given banks the flexibility and the agility that it needs in these times, and quick response time with very minimal bureaucratic processes is what is required. Whereas what we have now is that we have a committee which will go into which has gone in and given a report, submitted various ratios. Then you'll have to work out a resolution plan. The resolution plan in the case of large accounts of over 1,500 crores has to be vetted by the committee. Then if it's over 100 crores, you have an independent credit rating agency. So the whole exercise of lending, which should be a quick response action by bankers, has now been reduced to a somewhat bureaucratic ticking of the boxes exercise. So I doubt if it will really help. What it will do in the process, it will give bankers an excuse and it will give them some kind of protection where these ratios are met. But will this necessarily mean that you won't have NPAs 2 years down the line? I'm sorry, the answer to that is no.
Okay, five broad parameters. That's what the KV Kamath panel has recommended, and I'm just going to quickly walk you through. A, the total outside liability, adjusted tangible net worth. That's going to be one parameter. The total debt as opposed to EBITDA is going to be the other parameter. Current ratio, the debt service coverage ratio, or the DSCR, as well as the fourth parameter. And the other one being the average debt service coverage ratio as well. That's going to be the fifth parameter. So these are the recommendations made by the KV Kamath-led panel.